Let's talk some capital gains and who it actually affects. And this has been a recent topic in the news, but really just as a whole, I think it's a good mental exercise. Always good to make sure we have some critical thinking capabilities in our brains. And I don't say that as a dig at anybody, but just saying I believe that it's good to be able to think a little bit beyond just general blanket statements and actually think down through a couple things. And I don't believe that, because I'm certainly not. I don't think we should all be able to, launch rockets into space and be able to think at that level. But just like I said, some basic critical thinking skills. And I've had some people ask me about this, so I wanted to put a video out there. And I suppose maybe a little bit of a rant. And this has nothing to do with politics, because I will fully admit that both sides of the aisle do it. So government as a whole, I'm not looking at one side or the other, but of course here it is, we have a Democratic president who's presenting it. So yes, it's coming from that angle, but like I said, I fully admit from the get-go that if there is any rant, I'm ranting at just government as a whole, because government, and the PR departments, right? How can they spin things? They all do it. But that's where, like I said, some critical thinking comes into play here. And the capital gains tax is, especially if you're watching this, I'm assuming you have some sort of desire in the financial markets, maybe not in the stock market, but whether that be the Forex market, futures market, crypto market, any market, you have some sort of interest in financial markets and, growing your money. And therefore, the capital gains tax would apply to you. But that comment also, I'm assuming maybe, no, Clay, that it actually, you're wrong. It does not apply to me, because I see here, and I've seen in different articles that, and I've seen studies or whatever, that the capital gains tax is only going to affect the top 3%. So in other words, right, the rich, right? That's who that's all geared towards. And this is what I can't stand about politicians, is they know that that's not true. Now, they're not lying, because correct, in terms of who the rule applies to, who the rule affects, yes, the rule will only affect the top 3%. So they're not lying, but there's always secondary and third degree consequences, which I would like to think that politicians are aware of. And again, I'm not saying this towards left or right. I'm saying this towards just politics, government in general. I would like to think that they're aware of this and they just hope people don't notice. But I suppose I don't know that either. Maybe they just don't think through this stuff and they're not quite sure. But it does affect more than the top 3%. Because if let's think about it. In order to make this worth it, they need to make sure that a certain amount of people have a certain amount of gains, right? So very clearly, the top 3% must have a lot of capital gains if they're going to even bother taxing them. If that is a supposed solution, well, then by default, there must be something there that makes it a valid solution. And that solution would be, all right, well, there must be a big pot of money sitting there because this top 3% has a whole lot of money, right? But what does that require to have a big pot of money that produces capital gains tax? Well, you must have a whole lot of, stocks, right? Because in order to have a whole lot of capital gains that they want to tax, in order to generate that in the first place, you must own a whole lot of stocks, which is very, very scary for people like me and for other people, everyday, ordinary people, anybody, even if you have a Robinhood account. And I say Robinhood because that's kind of the traditional, hey, you're just a beginner, which is awesome, by the way. Good for you for getting involved in the stock market at hopefully a young age. Fantastic. So I don't say that in a judgmental way. I say it in a, hey, you know what? You have skin in the game now. The game is called the stock market, which again is now going to be taxed because these people, but it's only the top 3%. Yeah, but the top 3% own lots and lots of stock, own lots and lots of assets to generate all that. So why does that bother to us? Well, they're going to start to play games. They're going to start to do what they do. And I'm not saying that in a judgmental way, but they're going to say, okay, does this make sense for us anymore? What can we do to try to either avoid, to lessen these new taxes that could be coming? And if any part of that implies, you know what, we need to sell, we need to liquidate some of our positions, again, by default, these positions must be pretty large. And when pretty large positions are sold in the market, what does that do? Not necessarily the market, but to a stock or whatever is, that's going to send stuff down. And this is not rocket science. This is just basic supply and demand. Now, because stuff is going down, who is that affecting? Well, that's affecting anybody. So this is me, you, your grandma. she's got, I guess, a bum leg, because that leg, let me make that a little bit better. You got, anybody who owns stock in whatever is going down, they are now affected. Their value is going down, because if a bunch of selling causes an asset to go down, well, then other people that hold that asset, which is not just the top 3%, that they're going to suffer. They're going to also see their net wealth go down. Now, it's not going down because they have to pay more taxes. It's just going down because what they held and what it was worth, well, it's not worth that any longer. So they are taking the hit. This is now affecting them. Now, again, the rule is not affecting them, but this secondary consequence is affecting them. And it's a valid point, Clay. Well, since it's been announced, the stock market came down a little bit. Now it's gone back up, although by the time this goes public, we'll see where the markets are at. And you know what? That's a fair point. And there is there is an ace up the sleeve for now that may prevent this from going on. So even if the top 3% starts to liquidate positions, starts to maneuver in ways that could cause asset classes to come down, well, right now, the Federal Reserve is out there just printing money. And depending on where you're at, if you're a beginner in the markets, the Federal Reserve, they control the monetary supply. So they determine interest rates, and because that's how you control monetary supply. But basically, I'm not going to go down that rabbit hole. That's an entire probably video series in and of itself. But as of now, they're just producing more money, printing more money, printing more money. Money is just flowing into the system. So to be fair, stock prices may not go down. Maybe as the top 3% maneuver and are selling, the federal government comes in through the Fed and they're buying. So in other words, they're preventing prices from going down. And if anything, maybe the markets just keep on rising because they keep printing all that money, which is just a lot of governments do it. But the United States, we're a little bit different, especially when the world currency is still the US dollar. Will that remain the case? Well, that's another probably video series right there. But that is possible. So you may be able to say, no, Clay, even the secondary consequence that you're talking about, I see where you're coming from, Clay, but you're still wrong, because the Federal Reserve, the printing press is just going to keep things from continue to go up. Fine. And I'm not going to refute that. That's very well the case. So just to make sure we're all on the same page here, the context is, well, yeah, rich people may need to maneuver. Part of that maneuvering may be selling assets, and selling of assets, especially in larger amounts, can affect markets, can affect stock prices individually. But because of the Federal Reserve, that's not going to happen. They're going to come in. They're going to be printing money. They're going to be pushing more money into the supply so that they can keep buying stuff. And in general, just putting more money into the system to prevent that from happening, so that therefore the secondary consequence doesn't happen. Well, now we're looking here, if you already read the headline, at the third degree consequences. Just because you prevent asset classes and markets from coming down, if that's going to require more money, well, more money is just going to factor in inflation. So now you see, and this is all very recent stuff, but I didn't realize this, but right now, consumer prices rise more than expected. Really, more than expected. Who was shocked to hear that prices are going up when the Federal Reserve keeps printing money? But anyways, and then right here, pushed by 9.1% jump in gasoline. Now, it's way more than just gasoline. Lumber prices are crazy. But the point here being is, okay, you're still being affected. Anybody that drives a car in this example is being affected because, well, prices have gone up by 9.1%. In other words, that's basically a 9% tax, right? Because if you used to be able to go to the gas station and pay 9.1% less, but now all of a sudden you have to pay 9.1% more, that is just all of a sudden a tax that's been put on you. Nothing fancy, just basic. But again, where is this tax coming from? Well, it's coming from the fact that inflation is coming. Where is inflation coming from? Well, inflation is coming from the fact that the Federal Reserve keeps pouring more and more and more money into the system. Why are they pouring more and more money into the situation? Well, in our particular potential right here, they're going to need to if these capital gain tax go into effect. And then you look right here at another article, and this is, again, very up to date, but right here, price hikes are ahead. And then right there, and I'm not going to read the article. You can read these if you want. I'll put both links down below the video. But let's see, where's that? Yes, Procter & Gamble. So Procter & Gamble, they do all of deodorant, shampoos, shaving. All sorts of stuff that, assuming you don't want to smell like a greedy pig, well then, you're probably going to need their products, right? Toilet paper, all sorts of stuff like toothbrush. I mean, everything. It's Procter & Gamble. And then, of course, Coca-Cola. That's always, I think you've heard of them. But as you can see here, they are the latest companies to announce price increases are coming to help offset rising commodity costs. Rising commodity costs means the material that they are using to build their products is going up. Why is it going up? Because the government keeps flooding the system with more and more and more money. And when costs go up to produce your product, well, you got to raise the price of your product or else you're going to be at break even. And then eventually you'll start to lose money. And then right here, most retailers will pass on the, that was just terrible. Let's do this. Most retailers will pass on the higher cost to consumers, meaning you and I, which might not even notice the difference because of the savvy methods deployed by these companies. And they are savvy. And that's why they're so savvy that a lot of people are like, what are you talking about? My prices haven't gone up. It's the same. Well, it might be the same, but look at this example. Maybe there's a box of cement, a bag of cement. I'm going to just call it 10 pounds. And it's $20 for 10 pounds. Well, a savvy method could then be, hey, bag of cement, $20 for 8 pounds. Do you notice what happened there? Did prices go up? No, not really. But what did I do there? Wait a second, Clay, but it used to be $20 for 10 pounds, but I heard what you said. It's $20 for 8 pounds. Well, yeah, so think about it. Did the cement price go up? No, it's still $20 for cement. But then you break it down. Wait a second, but instead of $20 for 10 pounds, it's $20 for 8 pounds. Do you see the savvy marketing methods that they're doing here? And like I said, and the reason why you know this is coming is because, again, depending on how new you are to the markets, all companies have earnings calls. And part of the earning calls, as I talk to the analysts, they're trying to justify, explain what's going on, what they've been doing, what they plan on doing. And part of that is, hey, listen, commodity prices are going up, so we're going to have to raise prices. Now, of course, they're not going to make that public like, hey, run a commercial to tell you that. But when they're talking about things from strictly a business perspective, and those analysts want to know because the analysts are doing stuff to rate their stock. Is it a buy, a sell, a hold? Well, then that's where they reveal that sort of stuff. And that's where this author, Amelia, which is props to her, well done, is talking about. But that goes in all that stuff. And it's just, I think they talked about what Procter & Gamble. So right there, General Mills, cereal, James Schmucker, right? All this stuff. But all these people that you're going to use, toilet paper, drinks, food, prices got to go up because commodity prices are going up, meaning their cost to produce those products are going up, all because of inflation, money being pumped into the system. And the kicker here is that this is already happening before these capital gains have even gone into effect. So if they go into effect and you know that much more money or much more money is going to need to be pumped in the system, it's going to affect us from at least the third degree consequence there of higher prices going up. And once again, to sit here and say that capital gains tax only affect the top 3% is not a lie. Not a lie, because that's only who the rule applies to. That's who the rule affects. But with secondary and third degree consequences, well, you can see that it's gonna hit everybody. And I'm not saying whether or not you should agree with that. That's not my point here. I'm just explaining that the economics of it all, what's been going on, as I've just shown with literal evidence there, that's just how it's going to go. And whether you think that's right or wrong or where you stand, I'm not here to try to tell you that way. I'm just explaining who do capital gains actually affect. Well, they'll affect everybody. So the rule only affects to that, and that's the spin that politicians, the government as a whole, always tries to do. But a little bit of critical thinking there. You can see those secondary and third degree consequences will ultimately hit everybody. So that's my thoughts on it. That's how it works. And let me know your thoughts on it down below. I suppose you can let me know your opinion. I'm not looking to get in some sort of philosophical debate because, again, I'm not saying whether this is right or wrong or moral or immoral or wise or dumb. I'm just saying that who do capital gains taxes and an increase, who do they affect? Well, they're going to affect us all. So if you enjoy these types of videos where I break down kind of more so current event topics, then let me know in the comment section, or just really two ways. Hit the like button, leave a comment, even if it's just a thumbs up emoji. So hitting the like button and a thumbs up emoji communicates to me that you like more of these current event videos. If you don't like them, then I don't have to do them. But I'm always looking to experiment, try new things on the channel. So let me know your feedback down below. But that's how it all works. Hopefully it helps. Hopefully you can have some things to consider. But we'll see what happens with everything and see if these capital gains actually go into effect. First off, thanks so much for watching the entire video. Real quick, before you go, I want to invite you to a live webinar, web class, training, workshop, online event, whatever you want to call it, but it will be me live revealing to you what I've discovered that has allowed me to transform myself from being an employee to being my own boss, including how I had only one losing day out of 73 days in total. I'm going to cover 3 keys that have helped me unlock profitable consistency within the markets. The first key is super weird, but in a productive type of way. The second key is super awesome because it quite literally is wired into our DNA as humans, making it very easy to use. But in a cruel way, this becomes a pitfall for many traders. I'll explain it all though, including how to avoid the pitfall that it creates for some. And yeah, the third key, when you hear it, sounds way too good to be true, but it's not, and I'll show you how it all works. Then at the end, I open it up for a question and answer session that is, again, totally live. Even if you can't make the live session, please still sign up as it will be recorded, and you can go back and watch the replay that I will send you. Click the image on the screen or click the link down in the description box so you can get the date and time and claim your spot, which I should note is limited due to the fact that this truly is a live event. If you have any questions, let me know. If not, I'll be seeing you soon.